Welcome to StokTok's deep dive into Mitsubishi UFJ Financial Group. This is one of the world's largest banking institutions, headquartered in Tokyo, with operations spanning retail banking, investment banking, asset management, and corporate lending across Asia, Europe, and North America. It is a systemically important player in Japanese financial services and a key capital allocator across the region. As of May 8, the stock is trading at $17.95. Over the past 52 weeks, the stock has ranged from $12.75 on the low end to $20.15 on the high end, placing the current price in the middle third of that range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Mitsubishi UFJ generates revenue through traditional banking spreads, that is, the difference between what it pays depositors and what it charges borrowers, as well as through investment banking fees, asset management charges, and insurance products. The competitive moat rests on three pillars. First, the cost of deposits, which Japanese savers supply at scale. Second, the network of over 750 branches providing distribution advantages in a mature, sticky market. And third, a treasury and capital markets franchise that gives the bank access to deep institutional client relationships. The StokTok score for Mitsubishi UFJ is 41 out of 100, signaling caution. Breaking that down, valuation scores 7 out of 20, suggesting the stock does not look cheap but is not in distressed territory. Financial health scores 12 out of 20, indicating moderate leverage and some structural balance sheet headwinds. Profitability scores 6 out of 20, a yellow flag. Growth scores 14 out of 20, relatively solid. And smart money scores 2 out of 20, suggesting institutional enthusiasm is muted. Now, valuation. The question every investor has to answer: are you paying the right price? Mitsubishi UFJ trades at a price-to-earnings multiple of 15.79 times on trailing 12-month results. That translates to a forward price-to-earnings ratio of 12.90 times, implying the market expects modest earnings growth ahead. The PEG ratio, that is, the price-to-earnings divided by growth rate, sits at 1.96, suggesting the valuation is not trading at a deep discount to growth prospects. The price-to-sales ratio stands at 4.66 times, which is moderate for a global systemically important bank. Our DCF analysis suggests the stock is trading at an 11% premium to intrinsic value, implying the market is pricing in some optimism. Wall Street analysts covering the name have a consensus mean price target of $18, with a high target of $22 and a low target of $15. That implies modest upside of roughly 2% from current levels at the mean, though the wide spread between high and low targets signals genuine disagreement among the two analysts following the stock. Taking both signals together, a reasonable fair value range in our view sits between $15 and $20. Turning to earnings, the most recent quarterly results showed earnings per share of 7 cents, beating expectations of 3 cents, a material beat. However, revenue came in at $1,899.24 billion, a significant miss versus estimates of $5,848.14 billion. That revenue contraction warrants scrutiny. Year over year, revenue grew 2.70%, which is below historical trend for this institution. Market sentiment around Mitsubishi UFJ leans bullish. The bank's lending head has signaled further Asia deal-making expansion, and the broader Japanese financial sector is showing resilience. On balance, the valuation does not scream value, but it is not stretched either. Moving to financial strength. How solid is the foundation? The Piotroski F-score for Mitsubishi UFJ is 8 out of 9, indicating healthy accounting and cash flow generation across most dimensions. That is the bright spot. However, the Altman Z score registers at 0, a distress signal. In plain English, the Z-score model, which was designed to predict bankruptcy risk, flags some structural concern, though for large, systemically important banks, this metric can be less predictive than for smaller corporations because banks operate with higher leverage as a normal course of business. Cash to debt stands at 2.43, meaning the bank holds $2.43 in liquid assets for every dollar of debt obligations. That is acceptable. The debt-to-equity ratio comes in at 1.72, which is high but not unusual for a bank. The interest coverage ratio is not available in our dataset, but given the size of the deposit base and the scale of fee income, coverage is likely adequate. What warrants caution is the current ratio, which is reported at 0.00. This reflects the structure of bank balance sheets, where traditional current asset and current liability categories are less meaningful than for industrial corporations. The takeaway: Mitsubishi UFJ has the scale and profitability to service its obligations, but it operates with the leverage inherent to banking, and investors should not treat it as a fortress balance sheet. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is reported at 0, which signals either a data quality issue or an inherent measurement challenge for banking institutions. Return on invested capital, as traditionally calculated, is less meaningful for banks than for industrial companies because banks don't deploy capital in the same way. What matters more is return on equity and return on assets. Return on equity sits at 9.34%, which is modest but reasonable for a large, mature bank in a low-interest rate environment. Return on assets registers at 0.47%, also modest. Gross margin is reported at 0. This is by design, as banks do not report gross margins the way manufacturers do. Operating margin similarly comes in at 0. Net margin, however, is the key number, 27.61%. This is the percentage of every dollar of revenue that flows to the bottom line as profit. At nearly 28%, this is respectable and suggests the bank has pricing power and cost discipline. The concern is cash flow. Free cash flow margin registers at negative 6.47%, meaning the business is burning cash relative to revenue. For banks, negative free cash flow can reflect capital buildup for regulatory purposes or investment in the balance sheet, so it is not as alarming as it would be for a software company. Still, it is a data point to monitor. The profitability picture is mixed. Strong net margins but weak cash generation. Onto growth. Is this business expanding, and at what rate? Over the past 3 years, revenue has grown at 13.3% annually. Over the past 5 years, the growth rate has been 11.2%. These are solid figures for a mature Japanese bank and suggest Mitsubishi UFJ is gaining market share or expanding into higher margin business lines. The most recent quarter showed revenue growth of 2.70% year-over-year, which is deceleration. This is the miss we flagged in the valuation section. Book value, a proxy for shareholder equity per share, has grown at 9.70% over the past 3 years, roughly in line with earnings growth. The dividend yield is 2.74%, a modest but meaningful income component for patient capital. The growth picture tells 2 stories. The longer-term trend is encouraging at double digits, but the most recent quarter shows deceleration, which warrants attention in the next earnings season. One interpretation is that the company is cycling through a tougher period. Another is that growth momentum is waning. Management guidance and the earnings report on May 15, 2026 will be critical data points. Now let's talk smart money. What institutional capital is actually doing with this name? 6 top-tier investment gurus currently hold Mitsubishi UFJ as part of their portfolios, suggesting some pedigree ownership. However, only 3.6% of the institutional filers tracked in the most recent quarterly filings are net buyers. That is, institutions that own more shares than they did in the prior quarter. The threshold for bullish institutional sentiment is typically 50% net buyers. At 3.6%, the score is decidedly muted. This is a meaningful red flag. It suggests that despite the solid fundamentals and reasonable valuation, big institutional money is not rushing to accumulate the stock. Insider ownership, that is, the percentage of shares owned by company executives and board members, registers at 0.00%, which is quite low and suggests management has minimal personal capital at stake. Over the past 3 months, there have been 0 insider buy transactions and 0 insider sell transactions. This absence of insider activity could simply reflect blackout windows and trading windows tied to earnings, or it could reflect lack of conviction. In aggregate, the smart money signal is weak. The gurus holding the stock may have good reasons. Perhaps they believe in the Asia deal-making expansion or see value in the dividend. But current quarter institutional flows are not supportive. And finally, the verdict. Let's bring it all together. On valuation, the stock is neither cheap nor expensive. A fair value range of $15 to $20 per share implies the current price of $17.95 is roughly in the middle of fair value. On financial strength, the bank has adequate liquidity and reasonable leverage for its peer group, but it is not a fortress. Z-score concerns warrant monitoring. On profitability, net margins are healthy at 28%, but free cash flow margin is negative, a structural concern. On growth, the longer-term trajectory is solid at double digits, but the most recent quarter shows deceleration that needs explanation. On smart money, guru investors hold the stock, but institutional flows are muted, and insider ownership is effectively nil. In our view, a fair value range for Mitsubishi UFJ Financial Group sits between $15 and $20 per share, representing modest upside of roughly 2% from current levels at the mean. The most recent quarterly earnings beat on the bottom line but missed on revenue, and the deceleration in top-line growth is the core question that management will need to address. Mitsubishi UFJ is a high-quality, systemically important bank with a durable business model, but the current setup does not present a compelling margin of safety for new capital. This is a name for patient, income-oriented investors who believe in the Asia growth thesis and can live with mid to high single-digit returns. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on Mitsubishi UFJ Financial Group. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.